Hey everybody, we're here today to talk about why you should only ever purchase a home one time in your life and how everyone else that's involved in the home buying and home selling industry is getting rich while you lose money when you sell your house. In this video, we're going to go through a couple financial models that show you at what year in your home ownership journey do you actually move from selling your home at a loss to actually making a profit on having that house and selling it, and how you can use this information to make good financial decisions about when to buy, what to buy, and understand how it actually impacts your financial future. So my name is Eric. I'm the head financial planner and owner of Peak Financial Planning. We are fee-only fiduciary financial planners. That means we don't get any incentives or kickbacks for the advice we give our clients. I hope you find this video helpful. And if you do like this video or want to see other videos on this topic, please give the channel a subscribe. That's Peak Financial Planning. Like this video. And without further ado, let's jump into some of the home models that I want to use to illustrate what we're talking about in this video. All right, so we're going to go through 4 different models here to talk through why it's helpful to understand at what point in the home ownership process do you actually break even when selling the home, and how to use that knowledge to arm yourself so that you, one, don't enrich others who make money off of the churn or the transaction costs as a product of buying and selling homes frequently. 2, so you can make better first-time home purchase decisions. That might mean waiting longer to buy a more ideal home, because once you see the numbers, you understand how much you're truly getting, how much you're truly losing each time you transact, and if you do it too frequently. And let's illustrate at what point in the homeownership process do you actually break even. All right. So we're going to go through 4 different models. They all have the same assumptions. The only difference in the assumptions is that you hold the house longer for each of the ensuing models I'm going to show. All right, so this spreadsheet will be linked below in the description, but let's go through the assumptions. So we're looking at a home purchase price of $750,000, an interest rate of 7.5%, 30-year fixed rate mortgage with a 20% down payment, okay? And the idea here is let's understand how to evaluate the true cost of home ownership. When you buy a home, you don't only have your mortgage payments, you also have to pay property taxes, insurance, maintenance, and then you will also have to factor those accumulated costs into how much you've paid for living in that property for the duration until you sell it. So if we have a 7-year holding period for this house, this is a very common refrain. A lot of people are told that we can buy a starter home, and then trade up because property prices always go up. And therefore, it's never a bad decision to buy, sell the property for a gain later, use that to leverage your way into the next house. And I'm going to show you here that is flat out untrue. And the only people it benefits are the banks, the mortgage officers, the real estate agents, and everyone else except for you, the home buyer and homeowner. So what you can see here is if you have the property and you hold it for 7 years, you will have this set of payments in the highlighted cells. You'll have total payments of principal and interest of $350,000. Just so you know, $303,000 of that will be interest out of that first $350,000 you pay on your mortgage. Separate from that, you're going to have property taxes, insurance, and maintenance. And then this cell down here in yellow is the total combined costs of carrying and living in that home for 7 years. Only the costs that we've outlined here on the spreadsheet. Now we have a formula in this green cell here that tells us what would your home value be, let's say, if we had the average home rate of return or home price growth, which is roughly 5%. And after 7 years, that this $750,000 home would be worth $1,020,000. And then this next cell here, we combine the 7 years of expenses with the remaining balance on your mortgage that must be paid off in order to actually clear the home. And when you combine those, you find that you actually sell this house after 7 years at a loss of around $134,000. To add insult to injury, we now have to factor in the seller's transaction costs. And I've been conservative here. I only showed one side of the transaction costs. The assumption might be that if you sell the house, you're using that money to buy another house. So you'd have another X percent of costs in the next set of transaction costs as you buy the next house. But I didn't include that here. And you can see that the actual profit or loss here, which is in red, so it's a loss, is $174,000 loss for this home that you've held for 7 years, paid into, and are told that you will get a gain and can leverage that up. Now, a few qualifications. This is definitely interest rate sensitive. And so if you bought a home in 2021 at 3.5% mortgage or 2.75% mortgage, this is a different calculus, and that's why this spreadsheet has formulas. You can come in here and edit it. But if we're looking at the current interest rate environment, you will find that it is not lucrative, and also a flat lie that the home price appreciation will actually produce a gain for you. You will be $175,000 behind where you were if you do this process and sell after 7 years. Well, what happens if you hold the property longer? Obviously, the longer you hold the property, the more you pay towards principal, and you owe less on your mortgage, and the less you pay towards interest. What happens if you hold it for 15 years? Using the same formulas and the same spreadsheet, the only difference is we have a 15-year accumulation of all these expenses, and we hold for 15 years. You actually end up with a bigger loss because you've sunk more funds into holding on to this house. You have a $210,000 loss if you hold for 15 years, again, assuming the same assumptions. And yes, I know this is a model, but at the end of the day, 15 years, you still don't break even. So where do you break even? And the answer is it's somewhere right before 25-year holding period. So at 25 years, you actually finally have your first profit from when you combine all the expenses and do the same calculus here. You have a profit of roughly $61,000. You do sell the property for what appears to be a pretty big gain. But again, you have to remember all the costs and associated things that you sunk into the property. Now, one thing that's not included on the spreadsheet that is important to note as well is I did not factor in any capital improvements or home improvement costs that someone might do if they live in a house for this long. If you live in your house for 15, 25, or 30 years, you're probably going to put some money in there to either do big repairs like a roof or piping, or to just do quality of life improvements like a kitchen, a bathroom, or whatever it is to make it yours. That is not included in here. And if you did include that, you would see that even after 25 years, it's highly unlikely you actually have a profit. What happens if you hold it for 30 years? 30 years, you finally start to see bigger profit numbers. But again, if you're living in it for 30 years, the assumption is you're probably going to put significant home improvement money in. And that means you just probably won't make the profit you think you will. Now, what is clear is you won't make the profit that the world tells you or hopes that you will believe you will make. Again, the key thing here to understand is all these other industries in the home buying and home selling space profit off of frequency of transaction. The more times homes are sold, the more times people pay realtors, pay loan origination fees, pay mortgage officers, pay banks. Mortgage payments go up because the way the payment's structured is if you have a 30-year mortgage, your payment is $4,000. In this case, your payment would be $4,195 for all 30 years. It's flat and fixed. The bank doesn't like that. So if you buy up a house 7 years later, now they have a chance to reorient your mortgage payment so it's higher and can reflect all the things they want to reflect, which is more profit, inflation, all these things. It only benefits the other parties. All right, let's bring this video to a logical conclusion. There are two key takeaways. The first is that it is a flat out lie that homes are always a good investment. They are very interest rate sensitive, very timing sensitive, very price sensitive. And we are often led to believe that we make money on this purchase ubiquitously and that there's never any negative trade-offs. And I'm not trying to make this video to convince you to not buy a home, not at all. My purpose is to show you the numbers and then show you so you can make a great decision, which I think the best and wisest decision is in today's circumstances, think about buying the perfect home for you. Don't think about using trade ups or buying a starter home and trading up. It's most likely the case that you will lose money on that and end up behind where you were originally. And it's almost always going to be better to defer that decision. Now, again, a model like the one I showed that can be changed and formulas can adjust the numbers so you can adjust for price, down payment, interest rate will be very, very helpful to lead towards making the best decision in this scenario. The second takeaway is incentives really, really matter. Everyone else is getting rich off of the frequency of your home transactions. Real estate agents get paid for each transaction. Mortgage officers, the same. Banks want to increase mortgage payments over time because they don't love the fact that a 30-year mortgage is flat and fixed. They want to adjust it over time. So more churn in the housing market leads to a lot more money in transactions and fees going to all the other parties and to you and I as individuals and consumers getting poorer. So the moral of the story here is don't believe what you see. be very skeptical, and take action like building models like these or like looking through models like these for your specific scenario so you can make the best decision for yourself. These were all models that I showed, so they're filled with assumptions. They're not going to be perfectly accurate or accurate at all, but they're good for illustrative purposes. So I hope you found this video helpful. If you like this type of content and want to learn more about financial independence and how to navigate towards that journey, whatever stage of life you're in, whether you're young or you're old, and you want to make the best decisions with your money, you can find more of these types of videos on my channel at peakfinancialplanning.com. Give this video a like, subscribe to my channel so you'll get served more videos like this. And if you have suggestions for future videos, please put them in the comments below. Thank you for your time and attention, and see you in the next video.